Hi, Jim Gore from Thor Wealth Management. Well, the report that came out last week on inflation was a surprise to some, but was not a surprise to us here at Thor. Let's talk about inflation and where we think things are going to go in the future. Well, if you look at this chart here, let's talk about what is happening so far this year in the markets and really the dichotomy of what's happening in the commodity markets versus the financial markets. So if you look at this, you can see so far year to date that commodities are up 34%, where the S&P is down 20% and the NASDAQ is down over 30%. So commodities have done very well, and some people say, hey, is this going to continue? And the answer to that is probably, and I'll explain that in just a minute. First of all, you have to look at what has happened to commodities, just not in a short time period, but let's look at it longer term. So let's go back to 1990. And let's look at financial assets versus commodities. And if you notice this, if you had money in the S&P 500 in 1990, you're up over 2,000% over that time period. However, if you're in commodities, you're only up 34%. So in other words, commodities, all the gain has happened in the last 6 months. You were actually flat to negative over the last 30 years in commodities, and all the gain has happened in the last 6 months. The spread between financial assets and commodities, real assets, was the greatest it's ever been in history as of January 1st. So this is just the beginning of the run here in commodities, and usually it's a cycle that lasts several years. And let's talk about why we think that prices in commodities will go up in the future. And the big reason for that, if you look at this chart, is natural gas prices. Natural gas drives a lot of cost in all the commodities. Agriculture, you need natural gas in order to produce your fertilizer. So you're paying a lot more now for fertilizer because natural gas prices are up. So if you look at this chart here, this is looking at natural gas prices to commodities. And we like to use this as an indicator because natural gas has been highly correlated over the last 10 years. We're looking at a correlation of 75 to 95%. That of the commodity index. So it really drives what happens in commodities overall. And you notice, because of fracking, we actually saw commodities fall in price driven by natural gas. As fracking was coming up, we saw natural gas prices drop 60, 70%, and that caused all commodities to go down. But now, because of what we're seeing around the globe, especially with what's happening in the Ukraine and Russia, you're seeing a spike in natural gas prices, and you can see here that it's all happened in the last year and a half. And you've seen commodities, even with their 34% gain, has actually lagged. So the gap is the widest it's ever been. That gap is going to have to close. So two things have to happen. Either one, natural gas prices are going to have to fall dramatically, which is probably not going to happen with what's happening globally, especially with Ukraine, or commodity prices are going to go up. So this is telling us that the odds are that commodity prices are going to continue to go up. So that's one aspect of inflation is commodities. Also, another aspect for businesses are wages. So those are the two biggest costs for most businesses are commodities or cost of goods coming in and also wages. Well, let's look at what has happened with the unemployment rate here in the United States. And this is going back to the 70s, and you can see that the unemployment rate has been low. We reached an all-time low point just recently, but I circled this area because actually the last 3 to 4 years, we actually saw unemployment be very low, except for the spike up in COVID. So you take that out, unemployment rate is very, very low. People are fully employed here in the United States, and that's starting to cause wage pressures. And what do I mean by that? You look at this chart here, and I've looked at, this is the the quarter over quarter change in what your employment costs are. So you can see actually it was falling from 2000 to about 2016, 4 years ago. That's when we had unemployment rate reach about 3.5%. Notice it started going up there, went down a little bit because of COVID, but notice the last 8 quarters, it's risen dramatically. So you have wages are going up significantly, but they're still below the inflation rate. But we were looking at annual employment costs now of 5.5 to 6.5, 7%, for companies. So you're having increased wages. So wages and commodities are both going up at the same time. The Federal Reserve will have to be very dramatic with their with their increases in the future to keep inflation down. But even with what the Federal Reserve is doing, there's built-in things in commodities and employment that are causing inflation to go higher into the future. So if you have a portfolio right now that is all just in financial assets, just in stocks and bonds, even with the increase in commodities, what we're showing here is that commodities are a place that you want to have a portion of your assets. But it's just not commodities. You want to have things in your portfolio that are built to give you some protection against inflation. And we have that in our clients' portfolio, and we think it's important for the next several months or maybe even a couple of years to have that exposure in the portfolio. If you have any questions or concerns, as always, reach out to us at our website, thorwealthmanagement.com, or give us a call. Take care and look forward to talking to you in a couple of weeks.